Hey guys, and welcome back to the channel. Today, as part of my investing in quality real estate stocks series, I will give you the company analysis about Realty Income. Realty Income is famous among investors for being a monthly dividend payer, and Realty Income is also part of the S&P 500, and I believe they are one of the three REITs that are listed as an S&P 500 aristocrat. So all in all, that seems to be very good in the sense that they have a great track record already. Something else that's interesting is that they have in their slogan the monthly dividend company, so they're really trying to differentiate from that perspective, and I guess it is differentiating because most companies pay a quarterly dividend. And the monthly dividend is supported by over 6,500 real estate properties that generate a rental revenue from long-term lease agreements with commercial tenants. That obviously shows that they have a lot of real estate. The company right now is valued as about $20 billion. So it is a big company, but from what I've seen, it looked very interesting, so I'm going to share that with you today. So they have like a fact sheet on their investor relations page. You can download that. It's like 2 pages and you get a lot of valuable information from that. I really like the stuff that they share. It's all very valuable. So I suggest you guys to check that out. I'll leave a link in the description below as well. But I've grabbed the most interesting things from it as well because I just want to talk about it. So this is just a chart for their annualized dividends and dividend increases. So you can see as they started, they have only increase their dividends. Like maybe sometimes it's basically steady, like around that part, but it's not dropping. So that obviously gives you some stability as a dividend investor. And I guess in a REIT you want to see something like that because you don't want them to be too fluctuating unless there is a decent reason for it, of course. So they also list their investment highlights since the 1994 New York Stock Exchange listing. So that is about 26 years of a track record. Most important one, I guess, is this one, the compound average annual return of 15.3%. This is higher than the S&P 500 over that return, so that is quite impressive. Actually, really impressive. Then you have a compound average annual dividend growth rate of approximately 4.5%. To me, this is also pretty decent. This is what you would like to see as well. Just steady increase, and yeah, all in all, it looks very good. So the rest is obviously also pretty decent to look at. If you check this, total capitalization of 28.5 billion. Right now, it has dropped significantly because of the crisis we're in right now, and that probably makes this a better investment than before, because as we'll see later in this video, they didn't get hit that hard. So something else that I like to see in their fact sheet is that they showed this. What they basically did, okay, if you invested at the end of 2009 and you bought 100 shares of Realty Income, it would cost you about $26,000. That would be worth today about 10.8 years later, I guess, or well, 10.5 actually. It's just 10.5 years later. It would basically like increase by about 125%. Your original dividend income would be $1,700, and it would have been increased by let's say 50%. Is that correct? Yeah, about no, a little bit more actually, about 65%. Your original yield would be 6.6%, and right now yield and cost would be about 11%. Something else that's interesting, that over an investment period of 10.5 years, you would have had your like 91% of your initial investment back in dividends, and you would have had this amount. So I like that they showed this. I questioned this for a little bit, so I checked their share price, and I checked the share price at this, so I want to see if they were not manipulating the records. And I'd say that they could have picked a way better period to show a potential increase and how good of an investment it is. So it seemed like a fair measurement. So I really like that they showed this, and yeah, from the stability that you get, it seems to be a very decent investment. Something else that's noteworthy is this part, is that their share price over this period increased by about 8% compound annual growth rate. So each year they grew by about 8%. Then they have a nice list of their Realty Income performance versus major stock indices. So here you see Realty Income, and you see how they perform. Like, you can look at all the differences here as well. I find that pretty interesting as well. But for now, I'm going to stick to this part. And you see that they beat the equity REITs, they beat the Dow Jones, they beat the S&P 500 over this period, and they beat the Nasdaq Composite, the Nasdaq 100 basically. What I like about this is that they have included the last quarter. I guess they will have a new quarter soon, or they just released it. But you see that they had a significant decrease here. And if you look at, for example, the Nasdaq, it had a way better increase because of all the tech companies and how they have performed throughout the crisis, of course. So the fact that they include this and they still have a compound annual growth rate of this, it does say a 5 right here. I'm not entirely sure what that was about. But all in all, you can see that the compound average annual total return is higher than these indices. So looks pretty good. Now let's see what kind of real estate they own. So they had top 20 tenant diversification. Here you see all their customers. Like, I think for American standards, these are all pretty well-known names. Obviously, they're less known for us Dutchies, I guess, and other Europeans and other citizens around the world. But even so, I think we can still recognize a lot of the names. So these are all stable names. The one question mark might be FedEx, because we have seen a reduce in these kind of companies over the past few years. But who knows, maybe they'll do a good job with delivery of packages and stuff like that, and they could even become better. Well, and then we see a few things like LA Fitness, AMC Theaters, some Regal Cinemas. Those are real estate businesses I guess, that own the real estate or that pay rent to the real estate, that could have been hit hard by this crisis, but we'll have to look at that in a bit. The key statistics, obviously this is from QuickFS, something I like to do for my initial screening. I wouldn't look at these numbers, even though price to book is pretty interesting. You just see, okay, what is the asset value worth, meaning that you won't get it at a discount, but you get a very stable company in return. 10-year compound annual growth rates, revenue 16.5%, assets 20.3%, free cash flow almost 16%. These are basically numbers that I would like to see in any business, and the fact that they have it in a real estate business or a REIT is very interesting. So these numbers looking very good as well. Then we look at their share price. In February they were at almost $81 per share. Right now they're at 57. That's like a $23 decline. Based on 80 would say it's about over a 25% decline. Can we expect a steeper drop? Well, with this kind of stability, I'm already surprised that we have seen this kind of drop. But yeah, uncertainty does this, and all in all, I think the company is a very stable company and it looks good overall. So I wouldn't say it's overvalued or undervalued based on any metric, but yeah, it's a very stable company, and yeah, I'm not surprised that you have to pay a small premium for that, or a decent premium for that in current market environments. So retail portfolio store status by industry. So we have convenience stores, grocery stores, so on. Here you see how much percentage of their total contractual rent it becomes. And why I like to show this is that their highest, I guess, retail portfolio businesses are still paying rent, and well, it's not exactly paying rent, but that was a different sheet that I haven't included in this one, but they're all up and running. So their most important businesses are up and running. Then you have one theaters that obviously got hit, and only like less than half of them is running. But overall, you see that the total retail portfolio has only been hit by about 4%, which seems to be uh, decent, I guess. Like, it's not bad at all. And if you look at the share price and you see a decrease of 25%, then that seems to be an overreaction if you're going to expect that they are going to return to the mean that they have been following. Something else I really like that they included in their investor presentation is their average annual total shareholder return compared to the beta. And what is the beta? Is basically the risk that people define in stock market or stock price fluctuations. So what this shows basically is that for the average annual return, and take into account the fluctuations in the share price, Realty Income does very well on their metric. So sure, there are other companies on that metric. If you look here, like in this range, but sure, they have a way lower return. And if you go for this company, which could actually be a pretty decent company as well, haven't heard of that one before, might be one to look into as well. Yeah, you get a pretty decent return overall, and you don't have the same volatility you experience in an S&P 500, for example, and you actually get a better return. And why I like this is because, yeah, these terms are obviously, like, I don't see this as a risk, but it is a risk from an emotional perspective, I reckon. So the fact that they have included this, like, it's really, this makes them competitive with ETFs, in my opinion, because they use these kind of risk factors in their business. Something else that I would like to look at, okay, so they're paying a decent dividends, they have been increasing indeed, but how does that compare to the free cash flow? Seems to be doing a pretty decent job. It's about, I say, between 10 and 20% of the free cash flow consistently, and yeah, I think overall that's just what you want in a company like this. You don't want them to be at risk. I guess for a REIT, this is obviously pretty normal, but it is still something to check just in case and see if you actually agree with that. And lastly, what I would like to see, okay, so they have grown their business with 15% per year, or assets actually, but 20% per year. How has that been going looking at the balance sheet? So what we see here is 2009 and this is 2019. And we see that total assets has been increasing pretty immensely. And well, we can see the liabilities as well. But what is important here is, okay, how does the total assets compare to their total liabilities? And I don't just want to look at the most recent number and see if it's healthy. I want to see, okay, this company has been performing for a long time. How have they been managing their balance sheet? So from an initial screening, they always make sure that their debt is less than half of the asset. So that leaves us with a asset to debt ratio of less than 0.5. That makes it a pretty healthy balance sheet. What we can see here is that in general they tend to maintain that, except for the year 2012, where they had a little bit more liabilities compared to the total assets, but that was instantly fixed again in the next year. So it could be some kind of metric in the financial statements or something that actually like poisoned that a bit. Like it might not even be a correct representation of the current state that the company was in back then. So all in all, balance sheet looks good as well. So from an initial screen perspective, I think this company looks very good. And yeah, I can see why people like this. Like the fact that it's a monthly dividend payer, the fact that it has been growing so steadily, the fact that it has less volatility than the S&P 500, which if you don't worry about the entire diversification of stuff, you might actually want to consider just putting this in your portfolio, like even with the monthly dividend. A crazy risk person could even consider taking out a loan to do this and use the monthly dividend to pay off the loan. Like there is a... I wouldn't suggest that though, just to clarify. But yeah, it's looking like a very decent business. The only risk that I see, and I guess that's an overall REIT risk. Well, we are more and more going to an online world, and I think online shopping becomes more and more common, and yeah, even in the Netherlands, we see more and more online shopping, even for groceries and stuff like that, and that makes a company like this a little bit more vulnerable. So that's a risk I would like to mention for the long term. Obviously, if you look at the track record, this company is just an amazing, stable company that's looking very good. And yeah, from initial screening, I can't see any particular company risks that I would like to point out. The company's a little bit too big for me from a REIT perspective, but yeah, I can really see why you guys like that, or like this company. So that's it for today, guys. Let me know what you think of this company down in the comments below. If you enjoy these type of videos, please leave a like, and yeah, I would appreciate any feedback you have from me in the comments below as well. So thank you guys for watching, and if you would like to watch more real estate videos, you can click on the playlist in the end screen right here. As always, please keep in mind that I am not a financial advisor. The content on this channel and on my website is intended for educational and entertainment purposes only.